Welcome to The Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
All right, welcome back to the Money Huddle. Getting ready to be second half of 2020. We're back from a hiatus, self-imposed hiatus. The quarantine got a little crazy, and we decided, you know what, best thing to do is just to hunker down, hunker and bunker, and take care of business. But we are back, and with that, how are you doing?
A summer money huddle, buddy. It's good to be back.
Yeah,
I'm excited. We got a lot of things to catch up on.
There definitely is a lot of things have happened, and no better time than to just get back in, jump back into the fire, and get going.
So where do we start? Well, we're about ready to have sports again. Can we just bask in the glory that we may have Major League Baseball return? We may have NBA playoffs coming back.
I have to say that this might be the first year in easily a decade that I may actually watch baseball, because I'm like, there's nothing else on TV. I'm going to know like all these guys and their stats.
We got college football players reporting. Apparently they all have coronavirus, but we'll see how they're feeling. Come game time.
Now that's one sport that, man, you want to talk about depression will set in as if we don't get football.
Had a little oops reporting the other day. So I saw a headline come through that says Tuscaloosa to lose $2 billion in revenue if Alabama doesn't play football. And that got retweeted out a couple of times, and it got kind of broad exposure. And then the mayor was kind of like, that's $200 million.
No,
still a lot of money.
$2 billion versus $200 million.
Like, don't get me wrong, still a lot of money, but not quite the $2 billion it was projected to be.
That's like the reporter. That's like the reporter who was saying that Michael Bloomberg could give every American $1 million.
No, I know. It's crazy how fast it takes wind, and it's just like off and out there in the ether. And if that's the only thing you saw, you would never, see the corrected article. But I was like, wow, that's weird.
That actually made me think of something while you were saying it, and this is me just going like off the cuff right now. But I have found that our media situation right now, being the current state of affairs in our country, and this is across just about every platform, media channel, I'm painting with a very broad brush, has the desire to be first and fastest to report something is starting to really erode the quality and the correctness of what's being reported. Are we not seeing like people like they're launching this stuff and they're shooting it over the bow
we're in the Millennium Falcon, and it's just like light speed. It doesn't even, we're off the reservation of there being that much blowback if you're wrong. That's the challenge, right? You can tweet something out, and if it's wrong, what happens?
Well, what made me think of this, and this is probably not a good example, so forgive me, but just the other night, they were giving a press conference, and one of President Trump's people made the comment that the trade deal was over or something to that effect. And it was like, it hit the Twitterverse like wildfire. I even made a joke about it, and I was like, all right, how long? I was like, did they cancel the trade deal with China just so they could turn it back on again, like down the road to try to help with the political season? And no less than like 45 minutes later, they were already coming back out saying, no, it's not over. They were issuing corrections, but just like how fast you can't even misspeak anymore without it like catching wildfire.
Talk about oops. It's like, whoa, wait a second.
That's a good way to get fired.
So welcome back, buddy. It's good to chat with you. So a couple of things I just wanted to get out there to our listeners, a couple of issues that we just wanted to circle back to. So I wanted to get this out there. I saw Jeffrey Levine talk about this the other day. He was talking about the CARES Act update. So as most
Oh, Jeff.
our listeners know, the CARES Act had a slew of changes for retirees this year. Certainly on the radar was the suspension of required minimum distribution for 2020. But there was some confusion about what if you've already taken it, if you were diligent, if you systematically took your distributions monthly, or if you got in early in January and took a distribution, what to do. And so I guess IRS came back and cleared up some guidance on that and basically stated that, if you've taken an RMD in 2020, you can return that money to your account via basically a rollover.
Sure.
So you're basically making a rollover contribution back to the original, the account that you took that from.
Mm-hmm.
And so any amount equal to what your required minimum distribution was that you took out can be returned to that account by, I think you have till August 31st to do that. So I just want to get that out there. If anyone has taken an RMD and they did not want to take it, meaning they want that account balance back into their account, they don't need it to live on, you have some time still to make that return. And that does include beneficiary IRA. So I think that's important just to put out there.
I think, well, definitely for the beneficiary IRA crowd, because a lot of times they don't have any control over those RMDs. I mean, they just have to come out, and they're usually not included. Beneficiary IRAs are sometimes not thought of or not included when they think about legislation like that. So that's a good idea. And Jeff, man, kudos to him because he's been on top of that. Every time they put anything out, he's on top of it, trying to get it out to the world, which is pretty solid.
Yeah, I certainly appreciate him posting some of those updates and making it easy to go back and do that research. So important for our clients that have taken RMDs that want to make corrections to that, just to get that out there. Also, what the tale of a few months, huh? I mean, if we look back when we were doing podcasts in March, talking about one of the fastest drawdowns in stock market history from an all-time high to a bear market, fewer trading days, I think, than any other time in stock market, that we actually went from all-time highs to a bear market. And then in the last 3 months, I pulled this up on Y charts, Michael, S&P 500 last 3-month return as of our recording here today, 40% return.
That's crazy.
And it made me think of something. I saw Michael Lombardi, who is an ex NFL general manager, used to work for Cleveland Browns, used to work for Oakland Raiders, and worked with Bill Belichick some in New England, had a great post today on the Daily Coach. He said, doing nothing can be taking action. Being patient is a plan. I thought that was a really cool way to think about it. And the analogy that he gave to it was, he related that back to a goalkeeper in soccer. So a goalkeeper in soccer, if you're defending a penalty kick, there's an 80% chance the kicker is going to score.
Right.
80% chance that they're going to score. Now, in soccer, every goal matters, right? This isn't like baseball, football. They only may score 2 or 3 goals a game. He said 94% of the time, the goalkeeper would jump left or right in anticipation to try and block the kick. They did a study on this, okay? And they came back and they said, well, actually, if you just stood in the center and defended your area, you would have you would reduce that scoring to 60%. So doing nothing, standing there, defending the center of the goal, you're actually putting your team in a better position to win than if you're just taking action, jumping left and right.
Problem is, it doesn't look like you're doing anything.
Exactly why they said no one does it.
You got to look like you're doing something.
So this is the actual honest to goodness way that it was reported. Well, why do the goalkeepers do that?
Right.
Because if you're standing there, it looks like you're doing nothing.
Yeah, you're standing in front of a stadium full of people that looks like you don't care about anything.
Right. You're thrown out of the game. The second penalty kick, you defend and just stand there. And that's what's crazy, is that the best thing you could do for your team is really just defend that middle turf.
Right.
Make that kicker get it into the corners. And if they do, okay, they score. But if they don't, you're actually improving your chances of winning. And that that doing nothing can be taking action. I just think about people who stuck with their investment strategy. They had a painful March, no question, right? There's always short-term pain when we're investing in equities.
Mm-hmm.
But if they stayed committed to it and they didn't take any dramatic action, bouncing in and out of the market, except like you're trying to predict, right? You're jumping left and right, and they just kind of rode through, then hopefully those, investors have seen that, pretty dramatic rise back.
I was having a conversation with someone the other day, and the way I related to him was this. I said, we were talking, and it might have been you actually. I was thinking of that's where my brain is nowadays. But we were talking about how fast the market dropped, and I think we would have seen a lot more people panic out of the market, but it happened so fast. I think a lot of people got paralyzed, and before they knew it, they were down 25-30% in some of their accounts. And now they're like, well, gosh, if I sell now, it really does feel like I'm taking a loss versus, I'm trying to be early. But what's funny is I totally relate to that story, because sometimes the urge to feel like we're doing something that's going to help us can overtake. But I would also say that a lot of folks, when you have a plan, it's a lot easier to go back in and look if you've prepared. Like, say, look, we didn't know when we were putting the plan together, we didn't know when we're going to get hit with a bear market, right? But we planned for one right out of the gate. I know, when we're onboarding somebody for retirement, we run a bear market scenario that's pretty ugly right out of the gate. Like, we want people to be prepared. Like, hey, we might invest your money today and it might go right downhill like in the next 12 months, and we want to be prepared for that, because we really can't predict when those type of economic events like a black swan can happen and really create turmoil in the markets. But I also wonder too if folks that are trying to do it themselves, or they don't really have a well thought out written plan, they're just kind of trying to piecemeal together some of their Google sleuthing, and they're looking at 4% rule, and they're trying to kind of put some things together, and they don't have the sounding board or the experience, and then things happen. And then what's our natural tendency? It's like for like our lizard brain to take over, and it's like survival time. And we immediately forget everything we've ever read about, not doing that, and we do the very thing we know we shouldn't be doing.
So, and on that note, it doesn't mean that you should be flat-footed or ignorant to your surroundings, right? There is time that we need to take action, and there's generally activity that should be ongoing fairly routinely, right? That it's not maybe seismic moves, but there's incremental moves, fairly consistently.
Sure.
But it also means that sometimes we can make big jumps left and right like a goalkeeper, and it looks like there's a lot of action there, but in reality, we're not necessarily helping somebody grow. You mentioned something else I wanted to talk about today.
Okay.
It lead me right into my topics today, Michael.
That's what I'm here for.
So you had mentioned
your setup man.
Thank you.
Setup man.
You mentioned the 4% withdrawal rule.
Yeah.
As it relates to retirement income planning. And the gist is there's a few different, theories as it relates to retirement income distribution strategies. 4% rule is one of them. There's also a strategy that is, that's popular, that it relates to spending income, right? Spending yield. So a lot of those income-driven strategies that are income-based withdrawal strategies are really built on distributing whatever dividend or income is generated by the portfolio. And the benefit on theory of that is that you're not necessarily spending your principal, right? You're spending the cash flow off of the principal. And so it's a very popular topic because people like the idea of not having to invade their principal to fund their lifestyle, and living on dividends and interest sounds great, right?
Yeah.
Are you with me so far?
I'm with you, man.
One of the things I wanted to talk about today is just how quickly dividend payments can stop. And
Oh,
the theory of that portfolio, of course, is that, well, we need a dividend to distribute, right? If we're going to live off of the income and not have to sell the underlying security, then there needs to be a dividend paid. And a
right.
lot of times companies will have a very robust history of paying dividends and it looks rosy. And but the problem, Michael, as we know, is that that can change. And there can be events that happen within our economy, within the global economy, that can trigger a company to very, very quickly determine not to pay a dividend, whether
I
that's
would
temporarily or permanently.
Yeah, there also could be events with the company itself. The company may merge with another company. The company may change leadership, and you have a new leadership or a board that has a different vision for what they want to do with the business. And not to say that happens very often, but it can. And that's the thing is, like, I think if anything, if we can't admit that a virus coming overseas from China and spreading like wildfire can come from nowhere and completely disrupt anything. I think we have to be open to the concept that just about anything we can think of has a chance. It might be a small chance, but it has a chance of actually happening.
Well, come to mention, so a pandemic that requires us to social distance and to stay at home and work from home has a pretty dramatic impact on our economy.
No
And
question.
a lot of businesses have had to stop paying dividends. And so I was looking at a couple of different articles. And we'll drop these in the show notes, but there was a pretty good one on Seeking Alpha. It said dividends by the numbers. And this was looking at May 2020. And there's literally dozens of companies that have had to suspend dividends or cut dividends. And it's such a long list, Michael. I couldn't even read it off to you
Wow.
because, I mean, there's literally over 100 businesses, a lot of recognizable names that
Mhm.
would just see immediately and think, wow, they had to cut their dividend. But just I'll throw a couple out there that really kind of stood out to me. I mean, we had Disney
Mhm.
suspended dividend.
Yeah.
Wynn Resorts, Kohl's, MGM, Dunkin' Donuts, like Halliburton was one that kind of stuck out to me. Now they didn't totally suspend it, but they just reduced it, right? And so the challenge with that is if that's your primary retirement income strategy, and you could have an event like what happened in March with the coronavirus, that one, you realize very quickly, and dividend investors know that those dividends are not guaranteed, right? I think that's a fairly, I hope that that's very,
I don't know.
widely known.
I've had some interesting conversations with some people that are dividend investors, and they're like, well, so and so's raised it. They've had a dividend. They've increased it every year for 50 years. I mean, they'll spit their data out to you real quick.
Right. And so, but the other challenge is too, if we know that the dividend is not guaranteed, we also know that at the time that it could be cut or may likely be cut could also be a damaging period for the stock price.
Hmm.
So there's really two ways that we grow, make money through the stock market, right? Price appreciation, so capital gains and losses, and then income, like a dividend.
Right.
And if in one fell swoop, not only do you lose the dividend, whether that's temporarily or permanent, you could also be in a situation that now, for the first time, potentially you have to liquidate shares, but you may have to liquidate shares at a price point that you're not happy to be selling at.
No.
And so now you hit a crossroads of, well, what do we do? Do we, you know, source that income that we need somewhere else? Do we just wait, and just cut our expenses as dramatically as we can and hope for a sharp rebound, which did occur? But again, how quickly will those dividends return?
Well, that actually kind of goes into one of the things I was just conceptually going to talk with you about, and I wrote down on my little notes here, the Great Reset. And we've had conversations amongst ourselves just about how this pandemic, has impacted so many things, daily life, schools, education, hospitality industry, airlines, flying, cruise ships, business. contactless payments. There's just so many things. I could just rail off a list of things. And, I'll use the example this way. Companies that may, like you were talking about, need to cut their dividends because they need cash. Do they reevaluate once they kind of get their footing? Do they reevaluate their dividend policy and say, you know what? Um, we don't want to be caught like that again. We're not going to have as healthy of a dividend, or maybe we're going to take that money and we're going to deploy it differently than just distributing out. And that's the thing. One of the things about dividends is they're taxed, they're double taxed, because it's tax to the income to the corporation, then tax to the shareholder who receives it. But those companies, a lot of times, just as easy to them, they could take it and they can put it into research or other things, or they could deploy it differently than just doing a dividend. So I wonder how many companies, how many industries, businesses, business owners, states will be looking at this opportunity to say, okay, we haven't liked what we've been doing for a while, but this allows us to wipe the slate clean and essentially start fresh with the pandemic as the backdrop of, like, we're making this change and we're pivoting, and this is why.
Well, potentially could be that. It also could be that, a lot of these corporations have had to go out to the bond market and say, we're in need of capital and we need to borrow money. And how willing would you be to say, okay, well, I'll lend you money, but if you turn around and give it away as a dividend, I'm not going to, that may not fly with me. Or if you turn around and use it as share buyback, that may not fly with me.
Well, nobody wants that PR disaster. They even got Treasury Secretary, Mnuchin was up there saying, we really don't, basically they were saying, you really don't want to take this money and then be caught doing share buybacks. He's like, we really strongly discourage that,
So I think in some ways you're probably right. It will discourage, maybe it will discourage some otherwise lazy behavior of just distributing something out or buying something back. Finding a purpose for that money within your business is required now, maybe, to maintain your growth and your operation. Because a lot of those companies that I've rattled off, if they're in that travel and leisure, if they're in real estate, if it's oil and gas and energy, those sectors are in a bit of a crossroads right now, and we're going to see some will survive and be stronger, and there may be some that don't make it. And I think it's going to be up to the leadership of those corporations right now to determine who's going to rise to the top here. So, as an income strategy, though, going back to my original point, it sounds, just from a perspective of not having to maybe invade principle or invade principle less. It's an appealing strategy, just big picture, right? But the actual application of it typically means you may invest in a little bit higher equity allocation than you may otherwise be comfortable with. You may find yourself a little less diversified if you're focusing on only income producing assets. And in events like this, even though they're random and they're infrequent, can be quite harmful and damaging if you're not prepared for it. And so I just wanted to bring that out to the forefront, because we're starting to see more articles on it. It's becoming more widespread, but it's going to be somewhat pervasive, I think.
Yeah, I'll post a couple of articles, a couple of links to the articles we've been looking at in the show notes, where people, if they want to go and read about it. But you're right. I mean, there's multiple ways to see how things may play out, and I think that again, this is going to shape a lot of policy in the future, both in the business side of things and how they deal with employees, and how they deal with their own cash flow, and what could happen and what they need as a buffer. And I think it's going to be very, very interesting to watch some of this play out. That being said, I had a question for you, and this is something that we usually, I know we talk about this usually at the first of the year, but just kind of, we're right here into the second quarter, coming up pretty much into this week, or first part of next week. We'll end the second quarter, we'll start third quarter, and we'll hold our breath to see the economic data coming out. But this marks a period of time in the year where we tend to call it halftime. We're halfway done with the year. It's time to look at the third and the fourth quarter. And what are you looking at? What do you think people should be looking at, from a financial standpoint for the second half of 2020?
It feels like we're halfway through the decade. Are we halfway through? We're only halfway through 1 year.
It's only been 6 months.
I'm aging in dog years.
I feel like I'm 50 years old now.
I'm aging in dog years this year.
That's hilarious. It's true though. It's true. This has been a little bit longer of a trek.
So broadly, I think an event like this, a dramatic drawdown, fast-paced, intense drawdown with a fairly equal, not quite fully equal yet, but a fairly equal return. It gives everybody a sense of, how your portfolio reacted, but you also know how you reacted, and how you felt during that period. And this is a good time for individuals to think about, is what happened what I expected? Did I react the way that I hoped to? Did I feel uncomfortable? How badly? Did I move out of my portfolio? Remember, we don't want to jump left and right like that goalkeeper just because we think we're creating activity. We want to do something that we think is purposeful and useful for us to learn from. I think that's a really good experience to know where you stand, not only within your portfolio, but also your retirement plan.
Yeah.
The second thing, of course, is it gives everybody a shock to question where we're spending time and money. Okay.
That's good.
And look, I mean, there's certainly things we spent less money on over the last few months that is an eye opener for me. Right. But it's also, a good opportunity to know what you miss and what I miss doing, and what I was, if I could go the next 6 months, what I hope I can return to. So I kind of know in my own personal life, like, oh man, I really miss doing this, this, and this. I certainly want to get back to doing that. But then I also learned some things like, well, I kind of like, X, Y, and Z, what happened. But what a scary time, like we have an unknown virus spreading through our country. It's affecting people's livelihoods. It's affecting their families. It's affecting their jobs and income. And, it gives us a chance to really reflect and know what matters.
No, I agree with all what you said. And like one of the things, the little notes that I made by that comment on my notepad here was, the beginning of the year, we always encourage people, like, take an inventory of like what you've been spending your money on. Like, take an inventory of like, what did you subscribe? What subscriptions do you sign up for? What services did you sign up for where it's just easy to put things on auto pay, let them hit the credit card, let them draft the bank account, and kind of mindlessly move on. But I think, being forced to be at home, a lot of people have, put more, like you said, they haven't spent money on some things, but they probably started spending money on other things. And it's just a good time to just take a moment and just assess, like, okay, like financially, what have been my new patterns that have emerged in the last 3 months? Are they good patterns? Are they not good patterns? Did I sign up for 3 different like fitness apps and, for home workouts, and now I'm paying, but my gym's reopened. So now I'm, I still have them.
You wait. I'm gonna be on the market for a used Peloton here in no time. You know how many Pelotons are gonna be out on the market in like 6 months?
Don't say that, man. Don't say that. But no, it's funny because I know some people that bought some and then they were really disappointed when they realized delivery was going to be like 8 weeks. So there's all kinds of stuff that's happening, that will be interesting to watch play out. But it's always good just to take a moment and be sober about, okay, how have I been spending my money? How have I been spending my time? Have I been spending my time on, social media, or have I been, doing this, reading more? Have I been, taking up a hobby that I wanted to take up or something, and trying to actually develop some personal growth? So that's a good thing. And I'll leave you with this one too, is I'm going through a couple of courses right now. One of them, the questions that we were talking amongst ourselves the other day was, what's the difference between a goal and an aspiration? Because we're financial planners, and people come in the office all the time, and they'll come to us, and they we'll go through our discovery meetings. And how would you say, what percentage of people you say have more goals or have more aspirations than actual goals?
Okay, you've been thinking about this longer than I have. Give me your take, and then I'll fire back something because I feel you've
You don't
got
like
this
that,
mapped
huh?
out.
Boom! I hit him with the crossover. You see that crossover at the top of the key? Um, well, so the idea is that we all know that the goal is something that's actionable, and that we're moving towards it in a very tangible way, a way that we can track and see. Aspirations, and I've often used the word themes. Hey, I want to be, I don't want to worry about money. Well, that's a theme. I want to have enough money to travel. Well, that's a theme. Because a goal would be, I want to have enough money where every year during retirement I can spend $10,000 on vacations, or I can spend an X dollar amount, or I could take 3 vacations a year, and I want my vacation budget to be X, something that's actually tangible that you can see. And a lot of us, myself included, we get into our feelings about wanting to do things and how we want to be, but we phrase it, and we plant it in our mind in a way of like an aspiration, whereas versus taking the time to sit down and map out goals and like go through an actual goal setting process where you can break your big goals down into smaller chunks. Because obviously, if someone says, my goal is, I want to lose 100 pounds. Well, okay, we can easily quantify losing 100 pounds. But if you say, well, my goal is to lose 100 pounds in, 1 month, that action plan is going to look significantly different than someone who says, my goal is to lose 100 pounds over the next 12 months, and how you put those things together. And the same is true, I think, for our finances, because in financial matters, we have things that we want to do and goals, but we can only control, we get like every day we get a new role, and we get to go out and like attack the day. And that doesn't feel very exciting, because you have to stack days on top of days on top of days, weeks on top of weeks, and that takes time. But if we have a way to actually extrapolate that out, we can very well show people, like, look, this is our path. It's going to feel boring, but the compounding of those daily efforts over time will pay dividends. But if we never do that work and distill it down into actions that we can readily see, then we just constantly have these aspirations, and we're hoping we're going to get there, and we might get close, but we don't have the actual
Right. The
roadmap.
tangible measure, you're measuring your success periodically to celebrate small victories on the road to the larger, aspiration. Is that kind of the way you're phrasing it?
Or
Because
just you have mile markers along the way that you can check in and see, like, hey, are we, just because I think about it the way a lot of people think just about investing. We can all look at the charts all day long and historical rates of return, but if you go at any point in time on that chart, you can feel like, oh, we're doing great, or no, we're doing terrible.
right.
You
So here
know,
I'll push back a little bit, not, or maybe just take a slightly different angle. Is I've been thinking a little bit about habits and reading some James Clear stuff and thinking about what's the power of our systems versus just goals. So I could have
absolutely.
a goal to lose 100 pounds, but if I don't have a system of how to achieve that, it can't. I can't really ever reach it. Right. So, what's our retirement system? Right.
Hmm.
What is your accumulation system? Well, maybe you do a monthly contribution into your 401k, maximize at your income level, and allocate it in a way that aligns with your long term investment goals, and you're not making any changes to that, and you stick with it year over year over year over year over year, and it's a system, right? You get to the point where it's automatic and you don't even think about it. Or you could say, what's our system for handling your required minimum distributions? And we have a
Sure.
process in which we do it routinely, examine it, and follow a pretty rigid strategy, right? Like I'm to the point where we have to kind of take away some of our emotional biases that
Mhm.
lend us to the reactionary tasks that pull us away from those long-term goals, because the fear is so elevated, and we can be manipulated, right? Even the strongest mindset can be pushed in the wrong direction with the constant barrage of what's happening, right? I mean, even just think just in March, right? I mean, what's the look back on that? Well, of course this was going to happen. Of course these things, it's like not that obvious, right? It's never that obvious while we're in the midst of it, and it's easy to be pushed around a little bit. And I think it comes down to what our system that we put in place to stay within those parameters. Is that fair response?
No, it is. And I mean, and I think like what you said, you agree with me more than you may realize, because that's kind of the point. It's, so and the way we broke this down was, there's an aspiration, but it's like, okay, how important is it to you? How confident that you can accomplish that? And then like, how ready are you to get started? And so you start asking yourself just a higher level of question. And then you move that into where you're creating the system, like you said, because like, no, I can't, save $100,000. Okay, great. That sounds wonderful. How are we going to get there? Well, it's probably not really feasible for us to say, okay, well, let's just save $25,000 a quarter for the next year and you'll have $100,000. It's how do we break that down into something that's actionable, where it's like literally we can start working our system and
right.
build.
We talked about that before, right? It was like, well, have 6 months in savings, emergency savings of your income rolls off the tongue from an advisor, just like that's yesterday's news, right? We'll just say save 6 months. Well, that's saving 50% of your money for 1 year. That's not easy to do,
right? And if you look at the state of how people are right now, we constantly see articles written by financial reporters where Americans don't have X dollars, and it's a low amount of money. Like I've seen $400, I've seen $500, I've seen $1,000. Get your hands on $1,000 in case of emergency. I think we've got to start shifting that conversation. Like, okay, like we know we don't have that, but we also know that like the systems that we have right now aren't working. So how can we create new habits, new systems to get you towards that point?
Right. Cool. I'm with you, buddy. That was fun.
A lot of times with money, especially, is when the market's got things going on, is to talk about the market and investing and what's going to happen, and get caught up in this game of magic 8 ball, where what do we do? What's the best possible answer? And the real truth is, it's more important for us to just simply sit back and focus on the things that we can control and be just dedicated to saying, I'm going to focus on hammering away. I'm going to hammer this nail over and over and over again, and try not, like you said, going back to the beginning, not get distracted when the market does what it does, because that's money for 25 years from now. That's money for 20 years from now. I'm not going to get freaked out in the short run, and I'm going to keep hammering. I'm going to keep working my plan.
Here's the way I would summarize it. Be patient. It's okay. We can be patient when we're in these really stressful situations, and just take our time and think through what the right forward move is.
Sure.
So there you go, buddy.
There it is.
Let's do it.
Well, as always, thank you guys for tuning in. We are back, and we should be cranking out more consistent episodes now that our self-imposed hiatus is over with. Like I said, we're getting ready to turn into the second half of the year, and we want to focus forward, get ready to do work and be proactive in our financial lives for the remaining part of 2020. So as always, thank you guys for listening. You can find us on iTunes. Give us a shout. Let us know if there's anything you'd like us to talk about on the show. Shoot us an email at themoneyhuddle@vcplanning.com. And as always, we will talk to you next time.